Bonjour. En anglais.
Each team has 20 minutes to present its case to the jury. It will also assign for the last 10, 5, and 2 minutes, as well as for the last 30 seconds of the presentation. During the last 10 seconds, I will indicate to my reader the number of seconds remaining. If you have not finished your presentation after 20 minutes, you will be stopped in order to proceed with the question and answer period. Question and answer period of a maximum of 5 minutes is allocated to the jury at the end of your presentation. Please note that at any time you cannot say or regret the name or the location of your grievance. I will now let the judge introduce themselves. You can start your presentation when they are finished.
Hi, Caroline Jean-Bon-Massage, MBA, CPA, CA, et je travaille chez Laurent Jean-François Marcel pour le comptable professionnel inclus.
Mireille Dubé, MSC, CPA, CA, professeur ici à l'UQTR.
Mario Montagne, CPA, CA, CISA, MBA, Senior Manager at Deloitte.
Alexandre Berry, CPA, CA, MBA, travaille directeur d'association chez Sollicité et Comptabilité.
Alors, pour construire les saucisses, cela prend 6 étapes très importantes pour assurer leur qualité. Alors, ce matin, nous allons passer à travers l'analyse étape par étape afin de vous apporter nos meilleures recommandations pour votre entreprise. Alors, je me nomme Marilyn et voici mes collègues Nadia et Megan. Alors, bonjour, chère Jocelyne. L'ordre du jour pour aujourd'hui, nous allons débuter avec l'analyse et ensuite quelques traitements comptables à apporter à vos états financiers et pour conclure le projet d'investissement des saucisses. Alors, premièrement, une analyse des forces de votre entreprise. Alors, premièrement, vous avez amélioré grandement votre rendement en révisant vos processus de gestion. De plus, votre entreprise est très rentable. Nous avons découvert dans vos états financiers que vous avez un gros bénéfice net. Et puis, 85% des clients sont très satisfaits de la qualité de vos produits. Vous avez également certaines faiblesses. Donc, les clients trouvent que vous avez peu de variété dans vos produits, à 78%. Et aussi, le nettoyage des machines prend beaucoup de temps, ce qui implique certains coûts. Cependant, votre force est d'accumuler les commandes afin de produire au moins 4 heures de temps de la même sorte de saucisse afin de réduire les périodes de nettoyage. Il y a quelques opportunités qui s'offrent à vous également. Alors, il y a une possibilité d'agrandissement avec l'augmentation de la variété des produits dans le futur. Également, vous pouvez acquérir une nouvelle chaîne de production dans vos établissements avec votre agrandissement de 100 000 pieds carrés. De plus, 85% des clients voudraient des produits plus simples, ce qui nous amène à la technologie de saucisses sans boyaux. La menace la plus importante, c'est que les Québécois ne mangent pas de saucisses plus d'une fois par semaine. C'est pour ça qu'il va falloir probablement diversifier vos produits. Alors maintenant, voici l'analyse qualitative des saucisses sans boyaux. Alors, premièrement, les avantages, c'est que les Québécois sont très soucieux de leur santé. Cette technologie assure des saucisses qui ont moins de gras et moins de sel, ce qui va entièrement avec les Québécois. De plus, ça va permettre une pénétration massive du marché, ce qui va vous mettre le leader canadien de cette technologie-là en étant les premiers à l'utiliser. Ensuite, le panier des Québécois contient 40 kg de charcuterie et cela va en agrandissement au fur des années, alors ce qui est très bénéfique pour vous. Et puis, 50% des clients sont prêts à payer plus cher pour des produits de qualité, alors ce qui est un grand avantage pour cette technologie-là. De plus, les grandes chaînes, donc vos clients se sont montrés très enthousiasmés face à cette technologie. Il y a également certains inconvénients. Alors, le succès de votre entreprise est principalement basé sur les traditions. Ce produit ne fait pas partie des recettes d'antan. Ensuite, l'entreprise doit se remettre de récents investissements que vous avez faits. Alors, il va falloir faire l'analyse quantitative, voir si ce projet est profitable, ce que ma collègue va vous discuter avec vous prochainement. Ensuite, il y a des coûts de formation importants. Il y a un 15 000 initial plus 5 000 annuels à considérer. Il y a également l'embauche de nouveaux employés, car votre philosophie de gestion est de permettre aux employés d'aller dîner à la maison et d'avoir une bonne conciliation travail-famille. Alors, il va falloir embaucher d'autres employés si on veut garder cette philosophie-là. Et puis finalement, le projet doit suivre la stratégie de l'entreprise pour que le conseil d'administration soit en accord avec votre nouvel investissement, car ils sont un petit peu réticents. Alors, il va falloir vraiment leur présenter nos arguments qualitatifs, sont très convaincants pour ce projet. Nous allons voir prochainement le quantitatif. Alors, je laisse la parole à ma collègue pour poursuivre.
So some of the issues that came to us about were concerning capital property. Since you currently acquired new equipment and you have construction costs to build the new building in order to sell these new sausages. So one of the things you can do is you can capitalize the interest on both your equipment and your construction. So you're allowed to capitalize interest costs when you've incurred a debt and when you've started working on a project such as in a capital nature. So this requirement is met on October 1st when you get your loan, and it's until the building is ready, you are able to capitalize that interest. So from October 1st to February 14th, you're able to capitalize it. So that we worked it out, and it's approximately $23,000 that you're able to capitalize into that building that you've constructed. Next, there's the equipment, and you're also able to capitalize the transportation and setup costs. These costs should be removed then from your administrative expenses and put into your asset there, and this should then be amortized over its useful life. Now, you also can capitalize some of the interest costs for this equipment. If we assume that you purchased this equipment when you finished your building on February 14th, you'd have a month from when you purchased it to when it was ready for use, based on the cost, the installation, everything. And so that would mean that you would be able to capitalize 1 month's worth of interest. And since you've already capitalized $1.25 million, you only have $250,000 that remains that you have available to capitalize the interest on. And so this would work out to a little under $1,000 that you would add to the equipment. Now another issue is with this new sausage line, you're currently recognizing revenue when you sell your products to Ali Plus, but there's a stipulation in the contract that says that they are able to return any of their products within 10 days of purchase, which means that the risks and rewards of this product are not being transferred until 10 days after the sale. So after it's delivered, actually. So you shouldn't be able to record this revenue until you're sure that the benefits and the risks and the rewards have all been transferred. And so we did a quick calculation to see how much an expected return would be based on the sales in June. And we figured out that approximately 4% of your sales to Ali Plus have been being returned in the past months. And so if we take the sales in June of $450,000, we take 4% of that, we want to set up an allowance for returns of $18,000 so that you're not overstating your revenue. And so another thing is that you had legal fees to set up this contract with Ali Plus, and you have set it up as a deferred charge and you're amortizing it over 5 months, but you actually should be expensing it in the period incurred, as legal fees usually can't be deferred for this purpose, and so you'll have to add that back to your expenses. You also have non-current debt that you have worked out with venture capitalists. Now this is convertible debt that they are able to convert into 100,000 common shares at their choice. So now what you can do is you can split that up between a liability and an equity. Currently you have it set up as just a liability, but since you are a private company and you fall under the standards for private companies, you do have the option of reporting it either way. And so if you were to choose to set up a portion for a liability and a corresponding amount for the amount that refers to the equity, we could figure that out by taking a present value of the payments that you're making for this liability in the next 10 years and discounting it at the market rate for a similar liability without that convertible option. So that's 8%. And if we do that, we find out that this debt is worth approximately $1.3 million, which leaves approximately $150,000 to be remaining in that equity. And so if you do want to, you could split those two amounts out to make it more clear how much corresponds to each account. So next, Nadia is going to speak to you about some of the other opportunities you have.
So, your CEO is really excited about a new product called skinless sausages, and he's able to purchase the equipment to start making that as soon as possible. So you asked us to figure out whether or not this would be a profitable venture for you. So what we did is we looked first at the startup cost for skinless sausages. Because you're going to capitalize the equipment, because you're going to own it, it's not part of your startup cost, only retraining your employees and the additional advertising costs were qualified as startup costs. Next, we looked at the income you would be getting from the skinless sausages over the first 5 years. You estimated that about 15% of your initial sales would go to skinless sausages, so we started with 15% of your current sales, and we allotted it to skinless sausages in kilograms, and we transferred that to dollars, and you estimated that it would grow approximately 10% per year for the first 5 years. So we did the calculation for the first 5 years. We took off training and advertising costs as they carried forward, and of course the amortization on your equipment, and we came up with these numbers that look very, very good. You're bound to make between $2.5 and $3.7 million every year for the first 5 years. When you net present value that at your current cost of capital, which we put at 8% because you had to make a deal to get the lower cost, we came up with a net present value over $12 million. We think this is a very profitable investment for you, and we think that if you haven't done it yet, you should be doing it immediately. Next, we want to talk about whether or not you should lease the equipment or purchase it. Now, there are several benefits to leasing the equipment. First of all, you could, all the interest costs are tax deductible. You could be avoiding the risk of obsolescence of the machinery because you could lease it for 10 years or 5 years or renegotiate your lease as often as you like. The equipment has a useful life of 20 years, and it did have some residual value, but the technology could improve within the first 10 years and your machine could become obsolete that quickly. And it could provide some off-balance sheet financing. Now, the next thing that you asked us to look at is the diversified products. Your president is really excited about meatloaf. He thinks that the Quebec family is ready to diversify their meals. They don't eat sausage more than once a week. They're looking for different meals every time they sit down at the table. So he's not only looking at skinless sausages, which would be healthier for you, but he's also looking at expanding into meatloaf. Now, on your part, this would involve no initial investment, and considering the only information we had about the meatloaf is how much it would cost you to make it, that's what we based all of our calculations on with the other two products. So as you can tell, for your standard type sausage, you're making approximately 38 cents per kilogram that you're selling. Oh, sorry, per 100 grams. Next, we're looking at the skinless type, which is 0.58 cents per 100 grams, so that's your best money earner. And the meatloaf is going to get you about 51 cents per 100 grams. Now, the unit sale of it is 500 grams per unit, so it's going to be slightly higher than that. We just wanted a comparison across the board to see how profitable each one would be. And again, please note, we did not include any labor costs, any overhead costs, because all we had to base the meatloaf calculation on was how much it cost you to actually produce the meatloaf. Now, as we discussed, this would not cost you any initial investment, and the meatloaf is going to be the second most profitable product for you. Now, this is the simplest way to expand your product line because it does not involve any new equipment. It only involves starting a new batch on your machine, so you only have to clean it, and then you're good to go. The last thing we recommend for this product is doing a little bit more market research. Your vendors are willing to support you and willing to take on some of the advertising costs. However, if the product's not selling, that's going to go away very quickly. So what you should be doing is either getting your marketing department or hiring a marketing firm to do some market research for you and figure out whether or not the meatloaf is going to sell, whether or not the consumer wants it. So after doing that, you should be ready to move forward. The next thing we looked at is your interest coverage ratio. Because we made some changes to how your income statement is presented, we were worried that we would put your loan in jeopardy. Now, the venture capitalists require a loan coverage or an interest coverage ratio of 2.5 to 1. So we went ahead and made the changes that we recommended to your current income statement. And as you can see, we came up with a number well above 2.5. So currently this is not putting your loan in jeopardy in any way. Now, as we're talking about your loan right now, we would also like to mention that this is a convertible loan called by the creditor. So they can convert this loan to 100,000 common shares of your stock at any time. You don't even have to put your loan in jeopardy for them to do this. So we understand why you did it. 5% is much better than 8%, but at the same time, we're not sure whether or not this is going to cost you control of the firm if they chose to exercise this option. So, firstly, we guesstimate that you have approximately 100,000 common shares outstanding. So we figure that this call from the creditor would cost you control of your firm. What we think you should do immediately, if not sooner, is go straight to your bank and refinance the loan so that you can pay off that venture capitalist and have them off your books. It's going to be worth the extra $160,000 over 10 years for you to pay the 8% interest just to maintain control of your firm and have security in that the venture capitalist can't just come in there and take it from you. The last thing I just wanted to touch on is we saw that your last year's financial statements were audited and that this year's had not been audited yet. However, we would highly recommend that you continue with this practice. Auditing your financial statements, especially at this point where you've taken on more risk and debt, can only be beneficial to you. You can prove that you're maintaining any covenants of any loans that you have, and you can make sure that your company is in good financial standing. Now, in case you don't have an auditor engaged for a fully 5-year contract, we can get an independent auditor or an independent partner from our firm to perform the audit for you, or you can re-engage the firm who did it previously for you, or you can go out there and shop. We can do some recommendations for you if you were interested in doing something like that. Lastly, Marilyn's just going to summarize some of our recommendations.
Alors maintenant, je vais faire un petit sommaire de les différentes recommandations qu'on vous a apportées ce matin. Alors, on a passé à travers beaucoup d'informations, alors juste un petit sommaire, ça va nous éclaircir un peu les idées. Alors, premièrement, nous voulons faire le refinancement de l'emprunt. Alors, comme ma collègue a mentionné, ça risque de vous coûter le contrôle de votre entreprise si les actionnaires ont trop de... ils peuvent rembourser. Les créditeurs pourraient avoir le contrôle sur votre entreprise. Alors, ce serait bien de les rembourser afin que vous gardiez le contrôle de votre entreprise. Alors, ensuite, il faudrait capitaliser les emprunts, les intérêts sur l'emprunt. Alors, cela va vous permettre de pouvoir avoir cela dans vos éléments d'actifs au lieu dans vos états des résultats. Alors, ce sera un grand avantage pour vous. Et puis, finalement, diversifier vos produits. Alors, comme mentionné précédemment, une des grandes menaces de votre entreprise, c'est que les Québécois ne veulent pas manger de la saucisse plus d'une fois par semaine. Alors, en ayant d'autres sortes de viande à leur offrir, cela va vous permettre de pouvoir vendre encore plus de produits, d'être plus présent sur le marché québécois. Alors, toutes les entreprises comme le IGA, toutes les épiceries vendent vos produits, alors pourquoi pas leur offrir une diversité qui peut vendre encore plus. Cela va pouvoir fructifier vos produits, donc vos ventes, et puis cela serait très profitable pour votre entreprise. Il y a également l'investissement dont on vous a montré que ce sera très rentable pour les saucisses sans boyau. Alors, c'est un choix santé pour les Québécois qui veulent faire attention un peu plus à leur ligne. Alors, c'est vraiment un choix bénéfique pour votre entreprise. Alors, pour conclure, nous avons passé à travers plusieurs points, dont l'analyse avec les forces, faiblesses, opportunités et menaces de votre entreprise. Alors, une de vos grandes forces, c'est que vous êtes très rentable. Alors, cela vous permet de faire plusieurs investissements qui vous permettront d'être encore plus rentable. Ensuite, quelques traitements comptables à apporter à votre entreprise, dont mes collègues vous ont discuté longuement ce matin. Et puis, finalement, le projet Saucisse sans boyau, comme mentionné précédemment, qui est très rentable pour votre entreprise. Ça va pouvoir vous mettre leader sur le marché canadien. Vous allez pouvoir grossir votre entreprise, peut-être même de faire d'autres acquisitions dont vous avez déjà acheté un bâtiment de 100 000 pieds carrés. Alors peut-être dans le futur, vous allez pouvoir agrandir, être plus présent sur le marché canadien, pas seulement au Québec, mais partout au Canada. Alors qui sait, c'est à partir des petits investissements qu'on va pouvoir grossir le marché et puis augmenter vos ventes. Il y a également le petit souci qu'il va falloir au niveau des employés. Il va falloir embaucher des employés. Alors, il faudra faire un processus de ressources humaines pour pouvoir faire des entrevues et pouvoir passer à travers du processus pour pouvoir garder votre philosophie qui est vraiment idéale pour les employés qui ont une famille avec la conciliation travail-famille. C'est très bénéfique pour vos employés, alors cela vous permet de les motiver pour qu'ils soient encore plus efficaces au travail, car on sait que des employés qui sont fiers d'appartenir à l'entreprise vont demeurer, ce qui vous diminue les coûts de rotation du personnel. Alors, j'espère, nous espérons que nos conseils vous ont porté fruit et que c'est une qualité comparable à vos produits que vous offrez sur le marché. Alors, merci beaucoup.
My first question is about the contribution calculation. You said the 6 million, you don't consider the 6 million on the startup cost because it's a capital expense. But in the reality, I have to cash out to pay the 6 million. I can have some financial investment person who can help us, but finally, at the end of the project, I have to pay this amount. Why you don't consider the 6 million as a startup cost of the project?
We didn't consider it as a startup cost because you're taking amortization and because it would appear on your balance sheet. Financing it would be a different question. You would have to obviously find some financing for that, which is why also leasing would have been a better option for you. $6 million was a large.
In your okay, you don't make your contribution on the cash flow analyze, but on
And it looks like that within 2 or 3 years you'll be able to be making enough money that you pay it off. So although we didn't explicitly put it there, looking at the numbers you can tell that you would have paid it off very quickly.
My other question is about the normal capacity of the production. How you consider, because you consider the production of the new product as 12 million of revenue, but where you consider the impact of this new production on your old production and on the, you can't make all your product at the same time. You have one line, one staff, and how you made this impact of diminution of other product.
Well, that's why when we compared the cost per 100 kilograms, so we looked at the cost, the variable cost, and then the revenue. And so, as you could see, the skinless sausage was the highest earner, although you do have the investment to make in it. Whereas the second product was, I think, 51 cents.
Okay.
So what we would like you to do is concentrate on the ones that have the highest first, and then diminish your original product.
But this diminution, do you have counted in your contribution of 12 million?
That's just all that is the costs for the new product. It doesn't look at anything
And it's only
else,
the
yeah.
15%
It's only the 15%,
that it would
yeah.
be taking away from your sales. Like if you were producing a separate product, they wouldn't buy both. They would just buy
But
the
if
one.
you're predicting the 15% and you have a capacity of 60,000 kilogram, you can produce all your old production.
Well, you wouldn't have to. You would only have to produce 85%, and at that point, any
Yes.
diminished capacity you have there, you've just expanded, so it would probably be picked up by your additional expansion, or if you chose, I would produce the more profitable product first, and then everything
But
left
in your
over.
project calculation, you don't input this information in the 12 million calculation.
No.
I just want to clarify some points. To calculate the net present value of skinless sausage, what interest rate did you use?
We used 8%,
Okay.
which was your cost of debt originally without the deal to get the 5%.
Okay,
I chose to be conservative there.
Perfect. And concerning the revenue recognition, sorry, it's right on, and you said it too. We don't record like the sales that we estimate that will be returned. But if I have cashed the money, what do I do?
You can set up a payable and an allowance.
Mm-hmm.
So that's an amount that you're expecting to be paying back to the
Okay.
Perfect. company.
And just another clarification. When you first, at the beginning of the presentation, you said, just a second. Oh yes, capital property. You said that it can be capitalized. Is it a choice, or do we have it's must, or is it a choice, or
Capitalizing an interest?
yeah? Is it a choice, or I must capitalize the interest?
You must capitalize it.
I must. Okay.
and you told us that for the debt, we have an option to split between creditor and equity. What do you suggest? What is your recommendation? Do we split or?
I would suggest that you split it. It shows more the reality of what's going on in your firm financially, because you're taking on the debt where it should be, and then also you're kind of capitalizing that debt a little bit.
Okay. Thank you.